Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. In today's video, we're going to go back in history and do a technical analysis of different bear markets that have occurred since the 1960s. We're going to take a look at a very specific type of structure that we're currently seeing in the markets today and understand whether that's a typical structure that defines the type of price action that you tend to see in prior bear markets, or if it looks absolutely nothing like those. We're going to see how traders can be ahead of everyone else in this bull run by using history. And towards the end of the video, I'm going to show you why the move that we just saw on the equity markets is so important and how similar that is to previous recessionary bear markets. If you enjoyed this video, don't forget to smash the like button. It helps our channel out massively. It helps us grow. It makes all the effort that we put into these videos worthwhile. So that is very much appreciated. And of course, subscribe to the channel if you are new here. Now, without further ado, let's get right into it. So let's flash back to June 1966. Now, the market had already moved down significantly, around 12%, so smaller move than what we saw in 2022. But you're going to see there's a very interesting technical structure here. So what's the technical structure that you can identify that would actually mark whether or not price is still trending down? And one of the most simple ways to do that is to draw out a price channel. So you use the bottom reactions here. This reaction that you had in March 1966, this one in May 1966, you use these as the bottom reactions, and then you draw out your price channel. You extend that a little bit, and that essentially gives you the structure of the bear market and a great perspective on the trend. So let's see how things played out here, and you can see price reacts beautifully off of that level. This is so powerful because this is a reaction off a trend line that had no reactions prior to this top right here. You just use the bottom reactions to identify the angle of your trend line and use that trend line as part of the price channel to identify your selling point. So that worked out obviously beautifully in this bear market. Let's see if that's actually anything similar to the next bear markets we're going to take a look at. Let's do the same exercise for the 1970 bear market and understand if this is actually a price structure that repeats over time in bear markets. You take the bottom two reactions here, you use that as the price channel, you take the top reaction right here to identify a potential selling zone here. Let's see how things played out. You can see price coming up to test the trend line and rejecting right off of it, continuing the bear market that was obviously very severe after that. Let's see the 1974 bear market, understand if it played out exactly the same here. In 1974, let's hypothetically take this angle right here, extend it so it captures that high right here. You can adjust it a little bit to capture those closes at the bottom here. And we can press on the play button, see how things played out. And you can see price comes up, tags the top of the price channel, and then resumes its bear market. So bear market price structure, a price channel, clearly defining the trend using the bottom reactions, and you get a beautiful reaction off of that trend line that had no prior reactions before it. So you're really ahead of the game using that type of price channel because this is something that new traders are not very much aware of. Let's take a look at the dot-com bear market, a massive bear market that lasted from 2000 all the way till 2003. See if this is a similar price structure to what we saw in prior bear markets. Let's flash back to this moment right here, November of 2001, and see what price structure defined that bear market. We use these two reactions right here, connected to the high in August of 2000, a very significant moment here, and extend that price channel a little bit. Let's see how the markets reacted off of this bearish price structure, even though this trend line does not have any reactions. You can see market moves towards the channel, reacts off of it, and then the bear market begins to resume as you head into an earnings contraction that pulls down the market. Now, of course, this video wouldn't be complete without looking at the 2008 bear market. You can see this is a flashback to April 2008. You can see the run up here to the top in October of 2007. The market moves down into a bear market. I believe this is a 20% drop. And then you start to see the market move higher. Now let's see if that same price structure is respected. You take the bottom reaction right here, connect it to this reaction in January of 2008, extend the trend line, capture the all-time high in October 2007. Let's see how things played out. Did the market respect that bear market structure? and that is a perfect reaction off of that level, and the bear market resumes. Now let's take a look at today's market, understand if this is a price structure that is still intact in 2023. If you're so far enjoying this video, by the way, don't forget to smash the like button. Again, massive help to the channel. You can see if I connect these two lows right here in June of 2022 and October of 2022 and set that as the angle of this price channel, and we identify a resistance line right here using that December 2021 all-time high. You can see we have a beautiful price structure, a bearish price structure that is still very much intact and very similar to prior bear markets, and see the type of price action that you had leading up to the test of the trend line. But this is absolutely similar to what we saw in those bear markets, where you kind of have price go sideways for a while before hitting that channel. Now, of course, if we break out above this channel, that would be a bullish development. But the point is, from a technical standpoint, the SP 500 is still within this bear market price structure, and it's actually right near the top of this channel right now. It potentially already rejected. If you adjust the price channel a little bit, you can see here we potentially already saw the rejection off of this channel. So the conclusion of this video is that we currently have a bearish price structure on the SP 500 that has appeared in all previous bear markets throughout history, and it's still intact, and we're right below it. Now, if you've been following us, you'll know that we do have a macro bearish view on the stock market. We think we're heading right into a recession where the unemployment rate is going to begin rising here. We're starting to hear more and more stories about layoffs coming, and that's simply a reaction to the big rate hike cycle that we had throughout the last year. You can see again and again throughout history, when you have big rate hike cycles like we had more recently, and you have a very low unemployment rate, you tend to see a recession begin, and that is bearish for the markets. You can see, of course, in 1974, rate hike, recession that begins. 1980, rate hikes, recession that begins. So we're actively looking at these technical structures on gameoftrades.net. We update our tactical watch list with the ideal buy and exit points that we see on various assets. We have a model portfolio that decomposes the weightings of all our trades. We track it against the S&P 500 for complete transparency. So if this is a service that you think you would be interested in, don't hesitate to click on the link down below and begin your free trial. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't hesitate to smash the like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.